Good morning and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by Bryan Falchuk, who is founder and managing partner of Insurance Evolution Partners. But as I think we'll find out, he's a lot more than that as well. Published author, one of the futurists, looking at kind of the future of insurtech, looking at the current state of insurtech, many things. And we always enjoy his content over at the Leadership Insurance podcast. So we always say that we're very lucky, but today I do feel very lucky. So Bryan, welcome to the podcast.
Thank you for having me. And hopefully I don't steal all your luck and trash it. I've got a lot to live up to now.
Yeah, I know. I feel a bit mean that I've given you that much of a hype.
No pressure.
That's a difficult place to start. But yeah. Bryan, before we dive in, we obviously we know who you are, we follow your content, but just in case the folks that are listening, aren't aware, how would you put yourself in what you do, and particularly what you do at Insurance Evolution Partners, or all the other things that you get up to as well?
It's not an easy thing to clarify, but I always say I'm an insurance industry veteran. I've been around P&C for 20 something years, and through that I've spent time at carriers, consulting, insurtechs. And it's given me a really, I think, somewhat unique, but interested, more so perhaps an interesting, but interested perspective on where the industry is and where it could go. I like solving problems and I like opportunity. And so a few years back, I set up Insurance Evolution Partners to try to help the industry engage in the possibility of change, whether that's some carriers I work with or insurtechs, and kind of helping them navigate a bit of bringing their solutions into the industry and succeeding. To help drive that change. And through that, I've been putting out a bunch of different thought leadership content. You mentioned I'm an author, so I've got a book series called The Future of Insurance, a podcast series called The Future of Insurance, everything basically, because I can't come up with other names, called The Future of Insurance. But it's really, I just put all this stuff out there to give people something to engage in, to say, is there something in my context we could do differently? And maybe I can take a bit of inspiration from someone else who's done that. So I just like getting the stories of different players at different parts of the industry who are overcoming all the barriers we all talk about every day to try to innovate and evolve. Awesome.
And that's what I'm looking forward to, having this conversation, because I think, we talked a little bit just before we came on, and usually we're talking about, founders that have got a discrete solution. So it's really nice to have kind of a macro look at the industry, and particularly at the time, we're recording this in the later stage of 2022. There's been a lot that's been happening, and obviously there's a lot that's going to happen as well next year. So we'll probably make a bunch of predictions that won't happen. So that I'm looking forward to that throughout the course of this. So I wanted to look back at the year, particularly what we've seen sort of a trends perspective. So I mean, the trend that we've kind of acknowledged on a macro level from the FinPro team is that sort of the focus has been on underserved, underinsured markets, and the kind of opportunities that lie with kind of better customer needs. Do you see the same kind of macro trend? Is that what you've been kind of focusing on, or what's been your overriding 2022 takeaway?
Yeah, well, so interestingly, I think it's something I would agree with that I probably didn't even realize. If I'm honest, I think looking back, a lot of the earlier insurtech activities were in, by and large, were in sort of broad brush spaces where someone, looked at insurance, thought it was stupid, or the players were stupid or lazy or slow or whatever. Mm-hmm. And, we can do better and maybe be a bit cheeky about it in the marketing and take advantage of that. To different degrees of success. There's some players who really are just hype, and there's others who have a lot of hype, but actually there's substance behind it and their results play out. But on the investing side, there was also a lot of hubris and hype. And so lots of things got funded that maybe shouldn't have. Big TAMs, big potential upside, but not necessarily able to seize on that. In this year where investing's been a lot tougher, or it's been tougher to get investment dollars, I think while it's been hard, it's also been a good thing, because it's forced a rationalization where underlying economics matter, but also having a genuine reason for being matters. And so I think, to your point, that's why we get to see some more, maybe you can call them niche-y kind of solutions, or at least more specific, like there's a reason why this exists or needs to exist, rather than it's doing the same thing that someone else has been doing for hundreds of years, but their slate was clean, so they're not starting with legacy tech. Like that's not actually, to me, a material advantage, because the day you start, your tech starts to, your slate's no longer clean.
Yeah.
And so someone else could just come along a year later and be like, well, we've got an even cleaner slate, so now we're better. So when you have folks who are trying to serve underserved markets or create solutions where there wasn't one before, yet there was a need, someone is suffering and we actually have a mechanism to speak to that, or there's a gap in the customer experience or customer journey or how agents or brokers can do their work, and no one's really been solving for that. I think you've seen people looking for genuine reasons for being, and the same thing on the buyer side, and the investor side, where just being new tech, that's not enough to get funding or buyers anymore. So I think it sort of maybe comes from that rationalization. And frankly, it's nice to see, because we need that, and you're solving genuine problems.
Yeah. I think it's so true. It was really interesting, the earlier, very big, very large insurtechs, and I wrote an article back the other day that said, yeah, the second you start, as you said, you're getting tech debt.
Yeah.
But the other point I kind of wanted to make on the tech debt conversation and legacy tech, as people kind of want to talk about, is that I think if you come from tech and come into insurance, you can overplay the impact of that tech on things like profitability, on things like actually the customer experience, because a lot of the tech that we're aware of being bad, we're aware because we're industry people. We're not aware as a customer, not necessarily. You can change the front end relatively quickly. What we're usually talking about is the mechanics in the back end. How can we access our data? Are we recording the right data? But as a customer, I don't care. Like, I don't really, if your house is not in order at a big carrier, as long as you can pay my claim, I don't really care. So I think sometimes some of the emphasis was so heavily on, I know a lot of it was a customer experience, but I felt like customer experience was something that you can probably change quicker if you're a B2C player in insurance than you can anything to do with the back end. And there was a slight overplaying of that hand, as saying, whereas what they weren't taking into account, which was we've seen, they might have not been great at tech, but they're really good at managing risk. That's why they've been around for 200 years, 300 years.
Yeah, and that's the hard bit. So, I talked about that actually as the opening salvo in my first book, which was looking at all legacy players who had done something interesting and kind of innovative, because by and large, and it's not to say they've always been stellar underwriters or haven't had hard times, a lot of them going through that right now, but they have gotten the hard parts right. And the easy bits they've not gotten as right, and that's more on the CX and the digital journey kind of things that have become much more front and center. But they're learning and they're getting better. And actually, those are when I call them easy, it's not that they're easy, but they're much easier to make progress on, and they're easier to get right because we have a lot of answers for them today. Ultimately, you could say, well, we have answers for underwriting because we've been doing it forever. Well, if that was the case, we wouldn't have some who lose money and some who make money. We've already learned the lesson that accuracy in rating is unbelievably powerful, and that's the path to profitability. Yet, plenty of folks struggle with that. And we still seem to have some players out there, newer players in particular, who think that, selling $1 or €1 or £1 or yen or whatever of coverage for 20 cents is somehow some brilliant new idea. No, it's still a wild money loser, no matter how cool your brand looks, how great your tech is. That is not sustainable. And unlike tech and B2C, retail kind of things, scale makes you worse, not better. So that you don't outgrow bad underwriting. To an extent, because your books start smoothing, and like there are things that small books just inherently are problematic, because one loss can blow the whole thing up. But if you're fundamentally bad underwriters, getting bigger just makes you fundamentally a worse underwriter. So for a lot of them, it's like, well, it's just because we're growing. No, that's actually not the problem. You are fundamentally broken as an insurer. But let's not swear them off, because there's lots to learn from them. And I think that's actually something where the industry needs to do better. Is we have hubris on both sides. Hubris from the insurtechs for, oh, these dinosaurs, they don't know what they're doing. Well, they do know some things they're doing. You best learn from them on those things and do better on the other things. And the dinosaurs, the legacy folks, which I count myself in that bucket, we also can learn from these insurtechs or these newer players whether we think they're viable or not, surely there are things that really we should be learning from, even just the mentality of being willing to try things and fail and learn. And a lot of us need to get more comfortable with that. So I think ultimately the biggest shift I would like to see, and I know you didn't ask me this, but it's a mentality shift. And I think like we've got examples on both sides that speak to that, whether it's the hard stuff or the easy stuff.
I think I've seen that play out and I'd be interested to get your take on this. So, you know, we specialize in providing senior hires into earlier stage businesses. So we're typically working through seed to about Series B. The complexion and the makeup of the teams that I'm working with now, as opposed to 3 years ago. 3 years ago, it would be some tech entrepreneur coming into insurance, and you know, we might be hiring them their first insurance hire, but they're already up and running. They've already structurally up and running.
Yeah.
The teams I'm working with now tend to be, there's an insurance founding partner, and then there's a tech founding partner, and they've come together to go, right, we're going to solve a problem in the market. Or there are more insurance heavy knowledge, and they're acknowledging a problem, and then they're hiring in tech talent.
Yes.
So the change has been subtle but significant. Is that something
I totally agree with you. I think it's not that subtle, because if you're talking about a founding team of 2 to 4 people, if none of them versus 1 or 2 of them has an insurance background, that's actually quite profound. And I think you've seen a few where it's pure insurance folks, and that's okay. But my concern there is, are you know, has your horizon been open enough? Are you willing to be as tough on the things we've always done, and think in totally new ways, or structuring your thoughts very differently? So what I love to see is the mix. And then to think about, you know, how are they kind of coming together symbiotically or not? And is there actually a power play where one side is winning out more than the other? So I agree with you. I have seen a shift, and then I look deeper within that, and as I'm sure you do too, and you're thinking of placing someone or not, is how are they going to work together and challenge each other, and support each other? And, you know, I talked to some VCs who are like, we really look at the dynamics of the leadership team. And, you know, one of the VCs who told me that was bringing up a particular startup as an example of how great it can be. And I was like, well, I've actually done quite a bit of work with that startup, and I know the leadership team is 3 old friends who've worked together forever. They've done other startups together, and they're always on the same page. And when they disagree, they're disagreeing in unison.
Right.
Like, you know, they're all disagreeing with something they did. There isn't actually that healthy tension, because they've almost gotten too comfortable with each other. So I think you need to look for that and make sure it's survivable tension. But tension is valuable. It's invaluable, whether it's different backgrounds, different styles, different, you know, focus areas. But I think you're seeing more of that these days than you did with the sort of Gen 1 insurtechs in the mid to late 20 teens, as the word insurtech was starting to come to be.
Yeah, as we were still trying to debate how to spell it.
Does it have an E or not? I like efficiency, so I don't put the E in there, but you know, Caribou Honig disagrees with me, so that's his prerogative.
Yeah, I know. That always throws me out with the ITC. But no, I don't put the E in there either. But I think that's you and I sort of exchanged on something I put up on LinkedIn the other day, which is about mentors, which was the same kind of type of thinking. Was that I think now, if you're an insurance professional and you've got a mentor and you're looking to what your future career should look like, I worry if your mentor is a industry insurance veteran, and that's your only reference point. Now, obviously, it was me getting a bit bent out of shape because I was headhunting someone and they said no. But it did make me think. I mean, if you're talking to some industry veteran senior underwriter, and we've got an underwriting proposition which looks a bit unusual, I think if that's our only reference point, you're always going to turn it down. That doesn't mean that's not the right decision, but there's no challenge in thought process.
Yeah.
And it's the same for founding teams. If you don't have, and if they don't have equal weighting, like you say, if you're the tech-driven teams that I saw, and then they would bring that insurance person in, that insurance person is not on an equal footing. So they're not there to kind of give feedback. So, I mean, the makeup of teams is essential in the success of startups anyway. So healthy tension, I think, is a really lovely way of putting it.
Yeah. And at the board level as well, and the advisory board, I mean, I think the word mentor, like, let's broaden that out to all the different contexts where we get to have mentoring. And, you know, I think it's just as dangerous for a board to have for a board to be complacent as it is for them to be adversarial. You can't survive if your board is just fighting everything and making it really difficult. You have to ask yourself, why? Is it the board or is it you? Could be either side. But equally, you're also going to fail if your board is just rubber stamping everything. I think you need a healthy tension and you need a good relationship, whether it's your advisory board or your board or your mentor, your sort of career board, if you will, or just in life, you know, your friendships, your relationships, your life board. We need to find people who think like us and don't think like us, and have our context and don't have our context, and sort of ask around.
Yeah, I was thinking about the friendship thing. That came up in conversation today. I was out with a friend last night, and he basically disagreed with me on something that I'd done in my personal life, and that's why he's a good friend of mine.
Yeah,
he
right, exactly.
Showing that mirror to me, and everyone else hadn't picked it up, and they said, he was like, "I know, I don't think you did the right thing here." And he went,
yeah,
okay. You know, it was interesting and healthy.
Yeah.
I want to talk to you about something that a previous guest had said, and I think this is interesting because I saw the piece you did about customer experience, and I think this will probably play into that. We had a guest on previously. I want to say it was Herman Friend. I'm not sure, but I'll check and I'll put it back in the notes. But they said that the broker is the only true customer of the insurance industry.
Were they in the UK?
No, they were in Europe,
Okay.
and they felt that the insurance industry was completely built around the broker. Do you think that's true?
I think in some markets, yeah.
Yeah.
And I think, I mean, you like having worked at a global carrier, like when I was at Hiscox, I was squarely in the US business then, but you know, my peers running claims for the European continent, I mean, it's almost a foolish term to say like head of European claims, because every market is so different, and it does boil down largely to the distribution prevalence. You know, where some markets are really heavily broker driven, and some markets have really accepted bank assurance or direct sales or what have you. And you see that pervasive in what the customer experience is about, what people's expectations are, what sort of staffing we would need to have to support them through the claim. And so, you know, I'm trying to think if it was like the German market was very broker driven, if I'm remembering right. And apologies to any German listeners who are like, no, that's not correct at all. But I think it is. You really must be thinking about how you work with the brokers through those claims or any other part of the process. And I'm probably going to get one of these examples wrong, but I think it was Spain was more open to direct sales. And so you needed to think about your sort of D2C offering and support capabilities. You like the UK, there's a very strong agent broker community, and there's a very strong direct line wouldn't exist if there was no direct sales and bank assurance. And I mean, Tesco selling insurance. I can't imagine a supermarket chain in the US selling insurance, and lots of other non-food things. I think it is a local market question. Obviously, there's some markets that are similar, but then you have to ask yourself, how much is this the right answer, and how much is this a sort of defense of the past answer? So that to add some color to that, you know, in the US, we've got in personal lines, and 40-something% are still agent sold, but in commercial lines, quite a bit more. And I was doing some work for a small regional carrier in New York State that's agent distributed. And this is early days of lockdowns where, like, you know, you couldn't have two human beings that didn't live together already in the same building at the same time, basically. And so they had very old tech, did a lot of things through checks to pay insureds in claims. And the reason was the agents really insisted on getting a paper check, driving out to the insured and delivering it because they wanted to be the savior. They wanted to be the hero for the insured. And frankly, they didn't want the insurance company getting any of that credit because they were afraid of disintermediation.
Wow.
So they held really firm on that, which meant in COVID, you had the claim adjuster who had to figure out how much to pay. So they're in the office because their systems didn't work remotely. And then they'd all have to be out of the office one day for the check processing people in finance to come in to process those payments. So however long the claim needs to come to a determination, then add at least one day for that the check producer. But then the head of claims has to sign every single payment. There was no minimum threshold, which is, that's something that could be fixed. So that adds another day. And then someone else in the mailroom has to actually mail the check out to the agent. And the mail's running, the post is running slow. So like now we're talking 5 to 8 days, not business, but days that have elapsed since we figured out we have to pay 10 grand to this person. To then go to the agent has to drive out to see the insured, who those days may not have wanted the agent coming to see them, to give them money. What's that, 2 weeks maybe since the determination was made, let alone when the actual loss occurred? That business may be out of business by now. And that's very much a case of very strong distribution relationship and paradigm there in that part of the market that's completely failing to realize the impact on the customer. And that is a case of the agents, the industry's built around that distribution decision. And I think it's a bit like the music industry in the early days, or the publishing industry fighting against Amazon, where consumers have clearly said they want something different. And because that something different feels dangerous to us, we're going to make that impossible, and we're going to make them suffer, but at least we get to hold on to what we have. That never works out in the long term. Forcing people to have a bad experience because you want to keep things the way you have things might work today, might work for a few more days, but ultimately people are going to start pirating music, and Apple and Spotify will own everything, which is exactly what the music industry was afraid of. Amazon will rise to basically controlling book distribution, which they kind of do. Certainly book sales. As an author, I can tell you, like, it's basically Amazon or nowhere else. These are all the things that those traditional folks said, we never want to see that, so we're going to lock in and make it impossible. That doesn't work out ultimately. So even if that's how the market is, those players, those agents should be thinking, well, how can I stay relevant and important and valuable, but not because I've made it so difficult for them to do anything else. Don't make your customers hate you in the process of defending your existence. Find another way. And I think that's the challenge we need to give ourselves. Doesn't mean distribution changes or CX changes per se, but we do need to be more open to rethinking that.
I mean, I think one of the interesting misnomers for people discussing, particularly the outside looking in, the insurance industry, particularly carriers, I think I look at carriers and brokers slightly differently. I think brokers, I've seen much more resistance because they own that relationship. And you're right, like they are the middle person, and the middle person is always at risk. Every year I've been in my business, I've been told I'm going to be out of a job. First it was because Monster existed, and then it was because LinkedIn exists. And it has changed my role. Like, it has changed my role. We have to embrace that tech. I have to add value in different ways. There's a reason I do a podcast. There's a reason we have a networking platform for women in insurtech. These things are kind of adding value on top of kind of traditional services. But I think the carrier community, largely, I haven't seen a resistance to change. The people are, for example, we talk about tech debt. The person that knows how much tech debt there is at an insurance carrier is the CTO. They're not sitting there going, oh, we're unaware of our tech debt. We're like, we just can't press a button and change it today because we have all this stuff. So I think culturally, it's been interesting to me. Is that something that you've seen? I don't see this big resistance. I just see a sort of lack of ability to, maybe even lack of knowledge or lack of creativity to go in the right direction.
Yeah. Well, so I think it's a bit of that. And I think I think you're right that they do realize, like, yeah, this is a problem. But then it's the choice that comes in after that. So the choice to say, but we can't because, and we sort of like, I mean, it's like mansplaining, like we mansplain to, like, well, you don't understand. This is much harder than you think, so we can't just do that. It's like, well, okay, but these folks over here are doing that, so maybe you can. And the other side of it is, even when there is an acceptance, I hear things from carriers that are like, yes, we made a decision, we're going to move ahead, but just so you understand, it's going to be at least 18 months before this even begins, because that's just the way we work. And I'm like, for you to make that last statement, that's the choice. It doesn't just have to be the way. I always say, if someone says just, watch out for what's about to come, because it's a gross underrepresentation of the real situation. And I think there are moments where we actually could do things differently. Maybe it's like you said, we can put an outward facing CX layer on top of legacy tech. The tools are there. They're quite lightweight, easy to deploy, but actually for some CTOs or CIOs are like, that's too cheap. It must not be able to do it. Yeah. So it doesn't have to be $80 million. It could be 50,000. But it's like, well, clearly that's not good enough, or there's something wrong with it, so we're not going to look at that. These are all choices of how we engage. And I think that's what's exciting, is that's something, and that's part of what my work is about, is I need to chip away at that. We all need to chip away at that. But it's not for impossibility. And I do think you're right, generally in the carrier space, not 100%, but there is an understanding and an acceptance. It's now for us to start to challenge how much we can and can't do, or how fast we can do it. And COVID actually was a brilliant reminder, because, I share this in my first book. I talk about USAA, this like $28 billion PNC business roughly. At the beginning of 2020, they had scoped a project to begin at the end of the year, like Q3, to look at remote work. So 9 months from now, we're going to start looking at this. They said it's going to be a kind of 6 to 12 month initiative to then make a recommendation for what they could or couldn't do and how they could or couldn't do it. So 18 months, roughly speaking, till they had some sense of the art of the possible and where to move ahead. But it would be like a 2022 implementation. And of course, March comes, COVID hits, and they weren't one of these like, tomorrow morning, we're all remote. It took them 5 days, but it took them 5 days where they said it was going to be 18 months before they even had a sense of the answer. Yeah. And that was like, yes, it was hard. People burnt out, and I'm expanding this out to every one of these Herculean, super fast efforts. It might have been done with a bit of duct tape and hamster wheels and whatever else, but we did things super rapidly that allowed us to keep processing business and handling claims and what have you. I don't want us to forget that. So now the question is, how can we do these things in more sustainable ways so that people aren't burning out? Or we're not, just layering on all of this disparate tech and it's barely standing up anymore. But we can't just fall back and they're like, yeah, we'll put that on the 2-year horizon and we'll investigate it for a year and a half. It's like, that's not the world anymore, and it doesn't have to be your reality. So that's a choose your own adventure kind of shift that I think is in front of us.
The pandemic did a really interesting thing for large companies, because that's the perfect example that can we work from home. It's creating actually an environment of entrepreneurship, because entrepreneurship is, you have to make decisions, you have to make them quickly, you have to be able to change, you have to be able to adapt. Big companies don't have to do that most of the time.
Yeah.
So when you actually put those there's parameters in, what's fascinating is how well everyone rose to the occasion.
Yeah.
And good enough is good enough. That's, at a certain stage, it doesn't mean that you kind of, that's the goal. But, one of my things is that I've had various businesses, and they're not all particularly, I've owned a shop and owned a retail, brand, and that's not on the LinkedIn page. But so friends will go, oh, I want to start this business. And the answer is always just start. It's just like, just start, just go. Oh, it's not going to be perfect. If you wait for it to be perfect, you'll never do it. And so it's like the kind of rollouts of anything in insurance, and I worked in insurance. There's this big kind of conversation about this new claims technology, and it took forever to roll out. And when it rolled out, it was really bad. Yeah. But if they rolled it out in a couple of months and then this is bad, let's change it. All of that time could have been spent getting it right.
Right.
But it was trying to get it perfect ahead of time. Talking about your work, what's changed in terms of what people are interested in? Because you're there to support them through change, right? And advise. Yeah. You started 3 years ago. I'm interested to see the kind of journey of what conversations you were having then to what your conversations you're having now.
So I've actually been reflecting on this lately, because I've noticed a difference in the outreach I get for speaking and other things. I I think early days in my work, it was a lot more about something more point specific and tactical, maybe the wrong word, but it was like, we're struggling with this. What do we do about it? You know, do some analysis, give us a recommendation, come in and speak to us about these kinds of things in this particular area. And like, that's all fine. What I'm finding now is people are really curious for challenge. So, you know, come and speak to our board about what's changing in our space or around our space that wouldn't necessarily be a one-to-one analog here. But like I spoke at a board meeting for a workers' compensation carrier, and they wanted to know, you know, what are some early brewing things changing in workers' comp? And I said, you know, so I gave them a few things there. I said, but I want you to be aware of this thing that's happening over here. It's not directly relevant to your business. And we can talk about, you know, why that is and why it isn't. But I want you to see the shift in the dynamic and what it means to that legacy area, because there's actually things that could happen similarly in workers' comp. And I want you aware of that because you should all be curious and thinking about it. And I see people eating that up now. I've done some talks for a particular core system provider at some of their client events, and they were really, really clear. They're like, we want things that people may not agree with. We want things that people have a feeling about one way or the other, and they're willing to engage with. Because if nothing else, even if they come to the same answer they have today, that like, oh no, this is never going to happen, at least they've challenged their thinking to engage in it and to wonder, you know, what if, or what would we need if, and that's sort of how I position a lot of these things is, let's suspend disbelief for just a moment. Because you could be totally against this and say it won't play out, and that's fine. But what if it did? What are things you would need to have from an enablement standpoint, from a capability standpoint, to respond to that? And then ask yourself, should we be investing in those things anyway? And that was sort of the idea with that comp carrier, is like, this may never play out for you, and that's fine. But if it did, what would you need to respond to that? And if something similar were to happen, would those same enablers pay dividends? And so that's the question you should ask yourself is, are we investing in the right kind of things for the potential threats and opportunities that hit us? And I've seen, especially this year, much more engagement in like, can you challenge us? Can you tell us about things that may make most of us put our head in the sand or be like, yeah, that's ridiculous. And it's fine, it may be. But if we're not thinking about these things, that sort of exercise, it forces us to broaden our perspective a bit. We're probably going to end up missing something that was right in front of us otherwise. So that's different. And I prefer that. I don't like giving people specific recommendations on like, you need this tech or this solution provider or what have you. And sometimes people get frustrated with me that I don't tell them like, no, sign with these folks. And there's a right answer for every RFP, and that's fine. But like, that's not what we should be engaging in. That's what your RFP process is for.
Yeah.
I want to talk about your values, your culture, your thinking, your challenge, because that's the stuff that will ultimately lead you to success or failure. And I've seen more happiness to engage in that and requests for that in the past year or so.
Isn't that, I was just smiling when you were sort of talking it through, because all I could think about, I'm a big proponent of having personal therapy. I have therapy every week. I'm a big fan of it. It's the mental personal trainer. That's the way I've always looked at it. And as you're doing that, I'm thinking most of the time it's about challenging my thought process. It's about challenging what I believe about the world. And the point is, my sort of therapist always says, well, I'm never here to give you answers, like specific answers that you have to work it on your own. I was like, you're basically Bryan, you're doing business therapy with these people. You're going and say, look, all we can do is challenge your thinking. Because you can't, being prescriptive never works. Everyone's got to be on board. One of the things that I see, which is still challenging, there's a very large American insurer that I've done some work for. They invest in lots of funds, and the reason they invest in funds is they're very transparent. We want to see all the new tech, we want to see all the new ideas, we want to have an awareness of that, and that's the easiest way for us to see it. But then, interestingly, it's controlled by a very small team, so it has no visibility into the broader business. And my argument, is, what do I know about running a multinational tens of thousands of persons business? But I said, that is kind of meaningless if it's not being made aware. So let's say you're looking at claims tech. If your global claims director isn't seeing that, you know, what impact does it actually have? So it's interesting to hear that you're having those conversations at a sort of more expanded level. And I think generally I'm seeing that. I'm seeing initiatives supported more by senior C-suite execs.
Yeah,
But
I
it's
do think
still,
it's still very senior though.
yeah,
It's rare, I did a talk at the beginning of 2022 for Carrier, and they asked me to do it twice, once for their senior leadership team, plus like directors. So it was about 30 people. So definitely more than, the C-suite. But then they had me do it later in the day for like 90 people. And that was a sort of like mid-level manager group. And that's the only time I've seen that happen, where it was like, we actually need everyone talking about it. It's like, yeah, and if you're looking at a solution to invest in or otherwise, why don't you have, line adjusters and underwriters in those meetings? Because they're the ones who would actually be customers or users of this, or they're the ones who are at the coalface with the customers or the brokers or whoever, to understand whether, like, is that a problem or is that just some tech?
Yeah.
And like engage them in that, and the dividends that pays for what they then are able to do for all the people around them. I used to bring adjusters with me to, to sit with some of the startups, and it was like, all right, we're going to a WeWork for the first time. And have you ever seen, like, the kombucha tap and whatever? Like, it sounds silly, but actually it's just getting them out of the context they're in, seeing something totally different with people who don't come from their background, get them to engage in it. You may learn something about that solution, but you may learn more about the person that you just brought in.
Do you, shifting gears slightly, I want to review. So what we've both sort of said that we're reflecting on is we're seeing a lot more discrete solutions, right, that are working with the industry. So that's a trend I think is going to continue. Do you think the biggest insurtechs, as we define them, are yet to come? Like, I feel like we're building with all these discrete insurtechs, the blueprint of the modern insurer is like happening in front of our eyes. Do you think there'll be that huge player that comes in that really gets all this right?
Yeah.
Or am I just slightly deluded?
Yeah, like, is there an Aviva 2.0 brewing or State Farm? Yeah. Well, this is one of those moments we get to make a prediction, and hopefully no one ever, well, hopefully anyone listening, like, will be long since retired, hopefully still alive before any of this would have played out. I mean, I think this is a case of, I honestly have no idea. And I think, there's other industries where we could have done the same thing and been dead wrong. So, I mentioned the music industry. There's no new record label that has suddenly become, the likes of a Sony or BMG. Maybe that's the same company. I don't even know now. There's been consolidation, but you haven't seen a true startup that has risen to the top of a major. You look in the auto industry, let's rewind 15, 20 years, whatever it was. Is there going to be a startup car company that, rises to preeminence? Absolutely not. The barriers to entry, the fixed costs. And now we have the most valuable car company by a factor of many multiples was a startup. Tesla's, every time I check how many of the next public car makers is Tesla worth more than, every time I look, it's another one. So like 6-8 months ago, it was like 9 companies. It's 13 last time I looked.
Wow.
And so like, their value advantage is increasing. So they're getting better at the value game, not worse. Would anyone have said that 20 years ago? Probably not. Do I think Rivian or Lucid are the next ones? Probably not, but I don't know. And so I think it's really hard to make a prediction like that reasonably, because we don't know what will change. Like Amazon, I mean, just selling books, and then they added like outdoor furniture was their first product expansion. You're like, these people are idiots. Like, what are they? This makes no sense. And they're losing so much money, and they're all going to die. Booking Holdings, I just saw, like, they had a great quarter. Their component businesses in the .com days, 99, 2000, were huge money losers. And it's like, but look today. And so would we have made those right calls? I think we over-egged on some, we under-egged on others. So I don't know. I do think it's hard. And I think many of them are more likely to be acquired because of the scale of capital that exists in the legacy world. I think that's a mixed bag. I think for some of those acquisitions, it could create great possibility by the combination. I think chances are it will stifle more possibility than it creates, but I could be wrong on that too. And there may be one or two who do rise to preeminence. I don't think the the ones that will do that are the ones we're seeing talked about the most right now. At least one or two in particular I can think of. I don't know, like WeFox is another giant one. I don't know them well enough to know their underlying economics. But I think the sort of mega unicorns that we see, I haven't seen the right unit economics in the pure underwriting sense to suggest that like that is going to be the next Aviva. We're so many years on, hundreds of billions of assets. I have a very hard time seeing that because they're not accruing those assets as a viable carrier would need to. And they're carriers now, they're not just MGAs. So I don't know. So my answer is like, don't call me out either way, because I don't know.
I think your music industry analogy was or observation was probably the closest to how I think about it. That if you look at the disruption in the music industry that happened to the labels, it wasn't that there was another label, it was just that distribution of music changed.
Right.
And so in insurance, it's that seems the most likely threat, is that actually just the way that people purchase or engage with insurance is fundamentally changed.
Yeah.
Embedded is obviously, we joked before we came on that, if I had to talk about embedded again, I might go slightly mad. But the reason it's so exciting as a proposition is because of the way that we currently, it challenges how we currently buy insurance.
Yeah.
But having said that, the one thing I wanted to see was the data on how much, I spoke to someone that said they'd invested in like 4 embedded plays, and they said like 2 of them were making any money at all.
Yeah.
And only 1 of them was profitable. How many people are actually buying via embedded solutions currently?
Yeah.
But it makes sense. It's one of those that makes sense, but I still don't think is that, and bear in mind what we do for a living, talk about it all the time. I still don't buy anything for an embedded model because I don't trust it. I'm probably overpaying, because every time I look at an embedded solution, I'm usually overpaying. I can usually get it cheaper by going somewhere else. So, I did this with mobile phone just recently. They tried to sell me some embedded mobile phone insurance. Travel insurance is exactly the same, so.
But it's the cost of the process of looking for yourself. So if the travel insurance is £23 and you could get it for 19 yourself, it's like, yeah, but I got to re-enter it. Like, so that's the choice, that is what's convenience worth.
Yes.
And you find actually in travel insurance, the embedded offering does so much better than the standalone ever did. But maybe you could get it through your credit card.
Exactly.
So then I don't buy it because I know I've got it if I use, card X. And so I don't need to spend or worry about it.
Yeah. So I think, I see the true disruption, the true kind of change and evolution is, rather than I think we'll see a new carrier. I think we'll see loads of new carriers, but whether they're any better, I think the carriers have got very, very good at what they do. They can just get better at it, and maybe the rise more of carriers acting like almost like a hedge fund and say, right, we've got this pot of capacity and we distribute it. We've already seen people like Accelerant come in with, that's quite an interesting model.
Yes. Yeah.
And I think we'll just see more players like that. So yeah, interesting. Well, I'm really conscious of time and I don't want to overstay our welcome. I appreciate that I've gone completely off script and asked you hardly any of the questions that I pre-agreed to ask you.
I hated the questions anyway, so this worked. No, it was a good conversation though.
But Bryan, I want to give you the opportunity to kind of talk about what's coming up for you. Are you doing any speaking engagements? What's the best way to people to reach out to you?
There's always new ideas that flash into my head, and then I'm really lucky that I've gotten great opportunities to share them with people. I think I'm recovering from being on the road a bit, so there's nothing like pressing right now, but I'm sure that'll pick up again starting in January. But I've got all these signs behind me that the easiest way for people to engage in what I put out there, other than LinkedIn, which is how you and I connected, is at future-of-insurance.com. And I try to put, from a thought leadership standpoint, I try to like bang everything in there, the podcast, the books, papers that I put out, and I try to get as much of it out for free. Obviously the books aren't. If you have a Kindle Select subscription, I think they're free. But otherwise, like my intention is just to spark the industry thinking and engaging in this stuff. So there is a lot you can consume, and I hope people do. And by the way, I hope you disagree with me or challenge or think of something else. and reach out about it. People hit me up on LinkedIn or Twitter or whatever. As long as I'm still on Twitter, which I don't know how much longer that'll be, but at least for today I am. I'm not I'm anti cesspool generally, so we need to see how this all plays out. But yeah, engage. Let's talk about it.
I think you're allowed on Twitter as long as you're not rude about Mr. Musk. Otherwise, you're all
Yeah,
fine.
that's true. Or pretending to be him. That's apparently that's how you get banned. Yeah.
I've never seen a man with so much money be so sensitive. It's quite.
I've seen that a couple times, but yeah, he might be.
Well, not quite as much money,
Yes, yeah, right. No one like that. Yeah.
Surely with that much money, you can build a moat around your ego, but
Yeah.
seemingly not. Bryan, thank you so much. It's been a really enjoyable conversation, and I'm glad we got the chance to do this. So thank you so much for your time.
Yes, good fun. Thanks, Alex.
Thanks, Bryan.